Hey everybody, welcome to the guided assignment for chapter 11. This is doing bond transactions. Let's just take a look at it. Instead of me telling what you're gonna do, let's just do it. So on July 1st, Livingston Corporation, a wholesaler of manufacturing equipment, issued $3,400,000 of 5-year 9% bonds at a market interest rate of 11%. They received cash of $3,143,719. Interest on the bonds payable is semi-annual, December 31st and June 30th. All right, so for all the journal entries, okay, so you can read all that. So what we're gonna do is journalize the entry to record the amount of cash proceeds from the issuance of the bonds. So when we issue a bond, we're borrowing money. So our cash is gonna go up. And then our bond, I always skip the middle line, and then I say bonds payable is going to go up. In the middle, we're either going to have a discount or a premium. Okay, so let's just take a look at it. We're going to receive $3,143,719 in cash. But our bond payable, the amount we're going to have to pay back when the bond is mature, is its issue price, $3,400,000. So I can see from these first two entries, I'm going to have to do a debit entry to make my debits and credits equal each other. Whenever I get less cash than the face value of the bond, that's called issuing the bond at a discount. So I'm going to debit the discount on bond payable account enough to make this journal entry balance. So 3,400,000 minus 3,143,719, or 256,281. All right, so that should be in balance. I'll go ahead and check it just to make sure, and we're good. So there's our entry when we issue the bond. We're going to get 3,143,719 in cash. We have a discount of 256,281, and our bonds payable, the whole debt there goes up by 3,400,000. All right, so the second one is to journalize the entries to record the following: the first semi-annual interest payment on December 31st, and the amortization of the bond discount using the straight line method. So we amortize bond discount because we have to account for it across the life of the bond. Recognize this: if we get 3,143,719 in cash, but we have to pay back $3,400,000, then we're going to have an additional cost to borrowing this money over and above the amount of interest we're going to pay. Every 6 months, we'll make an interest payment. And that amount is this total discount divided up over the bond's life. So over the bond's life, we're going to pay a full $256,281. So what we're going to do is divide this bond up into the number of interest payments in its life. So if it's a 5-year bond that pays semi-annual interest, we're going to say it has 10 interest payments in its life. So whenever we pay these interest payments, we're going to have an interest expense that gets debited, and we're going to have cash getting paid out, and then we're going to have an amortization or a using up of some of that bond's discount. So let me show you how you calculate this. I always start with cash because I think it's the easiest to calculate, because a bond pays cash based on its face value and its face interest rate. So I'll say it's 3,400,000. That's the face value of the bond times its face interest rate of 9%. That's how much interest it's going to pay in a year. And then because this is a semi-annual or a 6-month period, I'm going to divide this by 2. So the bond's going to pay out $153,000 in cash. So we'll record that as a negative or a credit to cash. The discount, this amount right here, $256,281, we have to spread that out over the life of the bond. So since the bond is 5 years and we're doing a semi-annual interest period, we're going to divide this by 10. Why? Because there's 10 of these semi-annual interest periods in the bond's life. So we can see that we're going to amortize $25,628 per interest period. Sometimes people get confused, should I debit or credit this? The answer is if my discount, my total discount on my initial entry is a debit, then to amortize or reduce the amount of that discount, we're going to credit. So 25,628. And then once I figured out the amount of cash the bond is paying and the amount of discount we're amortizing, the two added up together are the total interest expense on the bond for that period, 178,628. So another way of saying this is the bond is paying out 100, or it has a total interest expense each 6-month period of $178,628. We're going to pay out $153,000 in cash, and the rest of that expense comes from the amortization of the discount. Remember, I said before that the discount is the difference between the amount of cash we got and the amount we're going to have to pay back. So it's an additional expense or cost of borrowing that money. So we're just going to divide that total expense up into 10 payments over the 10 interest payments in the bond's 5-year life. And then each 6 months we'll amortize one of those tenths off and claim it as an expense. Okay. And then the interest payment on June 30th is going to look exactly the same as the one on December 31st. So we're going to have an interest expense, a discount on the bond payable, and cash. The amounts will be exactly the same because we're doing a straight line, meaning we're amortizing the same amount every interest period, and the cash payment is always based on the face value times the rate times time, which in this case is 1/2 or 1/2 of a year. We'll double check it. Looks like we're good. So it asks us to determine the total interest in the first year. Recognize that these are semi-annual interest payments. So in most years, we would have an interest expense of 2 times one of these payments, okay? But in the first year, it wasn't issued until June, so we just have one. So our total interest expense for that first year is just going to be $178,628. It asks us, will the bond proceeds always be less than the face amount of the bonds when the contract rate is less than the market rate of interest? So that's a little confusing because contract rates don't change, but market rates do. Okay, so if the contract rate is less, that means the market rate moved up or increased. And when the market rate increases, then bond prices go down. So bond proceeds will always be less than the face amount when the contract rate is less than the market rate. So we're going to say yes. Finally, it asks us to compute the price of $3,143,719 received for the bonds by using the present value tables in Appendix A. So this is something that I didn't cover in the lecture, but I'm going to show you the process. So we round our present values to 5 decimal places, and then our final answer to the nearest dollar. And it says our total may vary slightly because of rounding differences. So the first thing we need to find is the present value of the face amount. What that means is if we were to, we know that at the end of this bond's 5-year life, it's going to be worth $3,400,000 to an investor, okay? Because that's the amount that the bond is going to pay back. So what we're going to do to figure out the present value, in other words, what is $3,400,000 5 years from now worth in today's dollars? And by today's dollars, we mean if we were to get a certain amount of money now and earn this market interest rate of 11%, right? How long would it take to make $3,400,000? But we're doing this in reverse. So we're saying, we know we have 5 years. We know we have 11%. So what is the value in today's dollars of $3,400,000 in the future if that amount of money had sat there for 5 years and earned 11%? Okay, it's a little confusing. So we're going to go to the appendix, and we're going to look at this first table, which is called the present value at compound interest due in end periods. So the amount that we're dealing with on this problem is we have 5 years, 11%. But remember, the bond pays semi-annually. So what we really have is 10 interest periods, and each interest period is going to pay half of that amount of interest, or 5.5%. So now I can look in here and say 5.5%, 10 periods, and this gives me what's called a present value factor, 0.58543. So if I come back here and I take that factor, 0.58543, and multiply it by the face value of the bond, I get the present value of $3,400,000. What that means is if I were to invest $1,990,462 today, and it went for 10 interest periods at 5.5% per interest period, at the end of those 10 interest periods, it will have grown to $3,400,000. That's what present value means. So the present value of the face amount of the bonds is worth $1,990,462. I better double check. Yeah. Then I have to find the present value of the semi-annual interest payments. Recognize that this bond is going to pay interest payments, cash payments of $153,000 over the next 10 interest periods. So semi-annually for the next 5 years. So again, I'm going to look at my appendix. I'm going to go 5.5. Well, I'm going to scroll down to this chart, which is called the present value of ordinary annuity. And annuity means a series of payments. I'm going to go 5.5% times 10 periods, 7.53763. And I'm going to multiply that by the amount of each interest payment, so which is 153,000. And so the present value of those future cash flows or those future interest payments is 1,153,257. If I add those together, that will give me, should give me the issue price of the bond, or not the issue price, but the amount we sold it for, the amount of cash we got, 3,143,719. So what they're trying to show us here is the process by which bond prices get set. We know that the bond is going to pay us 9% for 5 years, but that the market interest rate is 11%. So to figure out what the price of those bonds, or how much cash we should actually get for those bonds, is we're going to discount the face value, 5 years at the market interest rate. I should say 10 interest periods at the market interest rate of 5.5% per interest period. And then we're going to discount the cash payments the bond makes, also 10 periods at 5.5%. So that's the process by which bond pricing happens. All right, so there's our first problem. Let's move on to our second problem. It's going to be similar, except on this one, we're going to be issuing the bond. We're going to be issuing the bond at a premium. Okay, so Rogers Corporation produces and sells football equipment. Rogers issues 74 million. This is a big one, 400,000 of a 10-year, 10% bond, and the market interest rate was 8%. So now we have a market rate of less than our bond rate. They received cash of 84,511,444. All right, so to journalize the entry to record the cash proceeds, we're first just going to show how much our cash went up and how much our bond payable went up. Cash is the amount of cash we received for issuing the bond, 84,511,444. Our bonds payable goes up by the face value of the bond, 74,400,000. And then the difference we can see on this one, we're going to have to do a credit entry. And so anytime we get more cash than we on the face value of our bonds, that's going to be called a premium on the bond payable. And that's going to be 84,511,444 minus 74,400. So we got a premium of 10,111,444. We'll double check it. Looks like it's good. All right. So now we have to figure out our semi-annual interest payment. Just like before, our semi-annual interest payment is going to have an interest expense. And we're going to pay out some cash. And then in the middle, we will amortize a portion of that premium on bonds payable. So again, I start with how much cash, because cash is just the face value times the rate, which gives us a year's worth of interest, and then divide it by 2 for a 6-month period. So 74,400,000 times our rate, divide that by 2. That's how much cash the bond will pay out in a 6-month or a semi-annual period. The premium on the bond payable, we're going to take the total premium for the bond's whole life, which is 10,111,444. We're going to divide that by the number of interest periods in the bond's life. This bond is a 10-year bond, so the number of interest periods, semi-annual interest periods in its life is 20. So we're going to amortize 505,572 each 6-month period. So because our premiums has a balance on the credit side, and when we amortize, we're trying to reduce that balance, we're going to do a debit entry to amortize. And then in this case, our interest expense will just be our cash minus our premium. So you can see that with the premium, we ended up getting more cash than we're going to have to pay back at the end. So the premium actually reduces our cost of borrowing. And that's why we can see when we make our interest payment, we pay out a certain amount of cash, but not all of that cash is considered an expense, because part of it is the premium on the bonds payable that we're amortizing. Let's make sure that's right. It is pretty easy to make an error on these. All right. So our second interest payment, the one at June 30th, is going to be identical to this one. We're going to have an interest expense, a premium on the bonds payable, cash, and the numbers are going to be the same because it's the same period of time, 6 months worth, 3,720,000. Our premium will be 505, 572, and our interest expense right there. All right, so determine the total expense for interest. Again, because this first year was just June through December, 6 months, it's going to be this amount right here. It's going to ask us the question, will the bond proceeds always be greater than the face amount of the bonds when the contract rate is greater than the market rate of interest? So again, I have to ask myself, if the contract rate, that's the amount printed on the bond, which doesn't change, is greater than the market interest rate, that means the market rate of interest must have dropped. And if that drops, then the price of bonds goes up. So will the bond proceeds always be greater than the face amount if the contract rate is greater than the market interest rate? And the answer is yes. Okay, so this last one, just like the first problem, we're going to have to figure out the present value of both the face amount of the bond and the semi-annual interest payments. So the first thing I'm going to do is I'm going to kind of review this one. The market interest rate is 8%, and it's a 10-year bond. That means that there will be 20 interest periods in the bond's life, each of them paying 4%. So now I can go to my appendix and I can say 4%, 20 periods. My factor is 0.45639. And I will multiply that by the bond's face value. Remember, the face value of the bond was 74,400,000. The present value of that 400,000 is 33,955,416. So there's the present value of the face amount. Then we'll go back to our appendix. We will look at the present value of an annuity, 4%, 20 periods, 13.59033. And we'll multiply that by the amount of the interest payments, or the cash payments, which is 3,720,000. That gives us 50,556,028. And then hopefully the two of those together will add up to 84,511,443. Oh, 0.6, so 84, which does match up with what the price was. We should be good. We are. I hope that helps. I hope that you can kind of walk through that process and understand the basic concepts, at least, of bond pricing.